first episode of Let's Talk Finance. My name is Jesse. I'm your host, and today we are talking finance with Ryne Williams. How's it going, man?
Man, I am living the dream. How are you doing?
I'm doing good, man. I'm doing good. I just got back from vacation, so I'm refreshed. I'm feeling good, starting to get back into the workflow and the life flow over here.
So last time we spoke, you were in Spain, I believe. Was that where you went on vacation, or was that for something else?
Yeah, that was vacation. So we did like a 2.5 week trip, Spain and Portugal. So we flew into Barcelona, and then we slowly made our way down over into Portugal and over to Lisbon, where we flew out.
That sounds nice, man.
Yeah, it was fun. If I could change something, I think we would have gone to less places. Like we were at like 5 different areas, so it's like we were moving on every like 3 days or so, and that was a little bit too quick for me. Usually we do like a 5, 6, 7 days at one place, so we can really get to know the area. But it was fun. A lot to see.
So there were some places that you felt like you could have stayed longer, but you had to keep moving on.
Oh yeah. Oh, yeah. For sure.
What were they? For sure. Well, what were they, and which one did you like better? Spain, Portugal, kind of similar. What was the deal there?
So that was interesting because like everybody told us going into this that we were going to like Portugal a lot more than Spain. We like Spain a lot more than Portugal. And it might have just been like the people and the culture. But I was a big fan of like Barcelona was really cool. And Valencia was by far my favorite. Like by far, like I could probably spend a couple months there. It was a really neat area. So, and we typically like kind of more local places and being kind of more like just soaking up the culture and the people. So typically we like the less touristy areas, like being around a lot of tourism and a lot of tourists usually like is kind of annoying for me. So I think Valencia just like hit that sweet balance of there was a lot of touristy things to do, but you felt like you were kind of more immersed in the direct culture, at least where we were.
No, that's cool, man. That sounds kind of like the best of both worlds.
Yeah, for sure. So, let's get into this. So we are going to just chat about finance and different subjects. If you're watching, leave comments for any questions. And if we get enough questions, we'll probably do a follow-up episode, just doing a Q&A of the questions. So, let's jump on in and, just tell us a little bit about yourself, Ryne.
Well, my name is Ryne Williams. I live in Las Vegas, the greatest city on earth. And I'm a dividend stock investor. Well, I love it. But to me, it's the greatest city. But yeah, sure. I'm a dividend stock investor. That's kind of my jam. I make videos here on YouTube talking about dividend stocks, talking about dividend investing. I've been doing that talking about it for about 2.5 years. Been actually doing it for between 3.5 to 4 years now. So, I've have a little bit of experience, but that amount of time in the investing world is really like a drop in the bucket. So I still consider myself someone who's at the beginning stages of their investing journey, still at the infancy, which is fun. There's so much to learn about this stuff. But yeah, that's kind of me in a nutshell, man. I'm a diehard dividend investor.
Nice, man. Yeah. So much to learn, and the learning never stops, it's, especially in this world of investing. So, let's do just a random question. What's your favorite drink?
Okay. This is really a tough multiple question. So I'll give you 3, and then I think we'll narrow it down from there. So coffee is definitely going to be one of them. I love a good margarita. Oh, man, I daydream about margaritas. Margaritas would definitely be up there. And this third one might be kind of weird, but milk. I love drinking milk.
Milk. Okay.
I know it sounds weird, but my entire life I've always loved drinking milk, and I've actually. My family's really given me a hard time for it so many different times. There was one time where it was my first time going to Mexico on vacation. I think I was maybe 18 or 19. So I was old enough to have a margarita in Mexico. But, we land after a long day of travel, and instead of taking the edge off with a Corona or a margarita or whatever, I need to cool down with a milk. So as soon as we get to Mexico, everyone's in party mode. I'm over there drinking a leche, So my brothers like to give me a hard time for that still today. But yeah, those would be my favorite drinks. If I had to narrow it down to one, just probably would go with milk. Love it. Love it.
Wow. Well, all right, man. That's an interesting one. I was not expecting that. I was like, I know he likes margaritas. I've heard that before. Like he's mentioned that multiple times, so I'm sure I'll get the margarita answer, and then probably coffee. I was like, but man, that's a curveball. Good stuff. Good stuff.
I'm a man of many interests. I'll tell you that.
Yeah. So let's get into maybe a little bit about your background. Just kind of with money, budgeting, spending, your like kind of view on it. And you can go as far back as you want, as far as like growing up with money, just mindset around money, budgeting, savings, earnings, FIRE, if you're into anything like that. And we'll tackle those.
So I guess starting with my background with all this stuff, how I got into it, I'll tell you the investing seeds were planted pretty early on. I was maybe 11 or 12, somewhere in that age range, close to being a teenager. And my parents created a custodian account for myself and my siblings. And then from that point on, and my parents are pretty into investing too. So they understood the importance of it. They were big into it. So they wanted to push us to start thinking more about that stuff. But anyway, from that point on, any birthday, Christmas, Arbor Day, any kind of gift would needed to be given. It wasn't Xbox. I wasn't getting Grand Theft Auto. I wasn't getting like a new skateboard or anything like that. It was money from my Charles Schwab portfolio, which, at the time, being a teenager, being that young, it's not something I was really that excited about. I'd get, a few $100 to put into stocks and I'd be like, okay, great, Dad. Thank you. Don't know what I don't know who this Charles Schwab guy is, but he's whatever. And so I didn't really quite understand it, which is probably a really obvious statement. Most people that age do not. But my parents would always say, you'll thank us someday for this. At some point or another, you'll come around, you'll understand that this investing thing, it's really important and it's something that everybody has to do. And now, it probably didn't hit me until I'm 29 right now. I'll be 30 actually in a couple weeks, which is wild. But
wow.
Yeah, man. But it probably didn't hit me until I was maybe 25 or 26. And I don't exactly know what it was about that either. It might have been COVID. It might have been just prior to, maybe unhappy with the job and looking for a way out, but something, it's like a light bulb went off and I finally clicked that this investing thing is something that I needed to be doing. And so that's kind of what kickstarted the whole thing. And so immediately I hopped onto YouTube to learn about it and started getting my feet wet with some stuff that maybe I shouldn't have. I didn't get burned too bad or do anything too crazy, especially because I was, kind of playing with a smaller amount of money. But it wasn't long until I discovered dividend stock investing. And I don't even know if I'd heard the word dividend before, which is wild, even kind of growing up a little bit around this stuff. I really don't think I understood them, but it wasn't long until I found out about dividend stock investing. And the more that I watched those sort of videos from creators on YouTube, like PPC Ian, JJ Buchter, my man Russ Knopp over at Dapper Dividends, The Dream Green Show, Andre Jick, Graham Stephan would talk about him every now and again, but there were a handful of really great channels and I know I'm leaving some out. But something about that style of investing just really clicked with me. I really like the idea of being able to get these passive paychecks without having to lift a finger. And I understood, and I still understand it's a slow process, but these creators did a really good job as well of explaining if you start young, if you have more time on your side, it's okay because it's a long-term thing. And something like that really resonated with me. So long story short, once I found out about dividends, it wasn't long and didn't take long for me to get hooked on them. And so that's kind of led me to where I'm at today. I guess, as they say, the rest is history. But yeah, once I found out about dividend investing, I really hit the ground running. But that was nice. A very long-winded answer to my background with all that stuff. But I hope I checked all the boxes.
No, that's good, man. That's good. So when you, around like 25 or 26, when you kind of start taking it more seriously, and I think this happens with most people. I know for me, it's kind of like you're in you're in a position where you're like striving for something like, oh, I'd like to have more flexibility, or I'd like to have like more work-life balance or something like that. Was there anything like connected with those type of aspects, or like financial independence or anything that kind of really drew of you?
Yeah, I think so. I think it was probably a few things, but one thing that comes to mind is the thought that when I started doing this stuff, I was really admittedly not happy with my job. I was hating life. I was really not liking what I was doing. And I felt that if I just stayed in that job or stayed on that path, I wouldn't be happy doing that long term. And so I felt that I needed a way out of that. And for me at the time, not knowing where else to turn, maybe, I don't know, investing found me at the right time in the right place. Because once I started learning more about those sort of things, I kind of saw that as a way out of a situation that I wasn't happy with. I thought, if I don't do this, I'm going to die doing something I can't stand. And I know you can switch jobs, you can get out of the situation. I understand that. But these were some of my thoughts about it at the time. Generally, just really not happy with my job, looking for a way out. And I thought over time, dividend investing could be that way. I thought if I had to, worst case scenario, stay in this job or this situation for another 20 years, I'm 26. By the time I'm 46, that's not the end of the world. It wouldn't be the end of the world. I'd still have so much life left after that. But if in that time period, I could take the money that I'm making, continue to live below my means, which is something I've always been really good about, and stack that away, I could probably turn this dividend snowball into something that will be my escape route. It will be, I can see the light at the end of the tunnel. That's probably the best way to put it. I started to see the light at the end of the tunnel, and I was like, I'm all in on that. That's my way out. So does that make sense?
Oh no, for sure. And I think it's something sometimes that isn't, I think, talked about enough in the investing community. And it might just be that we're focused on investing, right? We're focused on the nitty gritty of investing, but you got to have that firepower to actually back your investments, right? So like being able to focus on, increasing your savings and stacking away a lot of money, like you were saying, that's your firepower. And hopefully we're going in with a pretty nice, fire hose of water and not a squirt gun, right? So
hopefully, but even the squirt guns, every penny invested is a step in the right direction.
Oh yeah.
So even if you have a little amount to invest, it's still better than nothing for sure.
Oh, definitely. And, it's amazing how some people that make so much money save relatively a small percentage, of that income. And you can have somebody making, half that is saving, say 50% or 40% compared to the person saving 5%. And they're going to be able to compound and eventually support their lifestyle so much quicker than the other person with the high income. So yeah, it's basically, on those type of calculations, it's all about savings rate and how you're going to compound that money going forward.
Yeah. And there's two different levels you can pull for that, right? You can lower your expenses. You can increase your income.
Yep.
Easier said than done for some people I know.
Yep.
But there's multiple ways you can go about it. And you can do both at the same time, which is like very powerful. That can really get that compounding going much quicker.
For sure. So another question here. Let's see. So what are some of your hobbies?
So
other than dividend investing.
Yeah. So other than this, I'm really big into health and fitness. I've been super into this stuff like bodybuilding, powerlifting type stuff. I know I don't look it, but been into this for about a dozen years now. After I graduated high school, like soon after I graduated high school, I got into the gym and fell in love with that stuff. So that's always been a big part of my life. In addition to that, though, I've always been into more not super extreme, but some of the more extreme sports like skateboarding and snowboarding. I grew up doing a lot of that stuff. I'll still snowboard every year. What else am I into? Really like drinking margaritas. I think we established that. It's a big hobby.
Yeah.
And as of today, I am a fan of pickleball. I played pickleball for the first time this morning with my friend Wayne, and that's fun. That was a lot of fun. I could see myself continuing to do that. Have you ever played?
No, I haven't. But
you should try it out, man. It's cool.
I'll have to. I do snowboard as well, though. So
nice. Nice.
The wife and I usually ski or snowboard.
Yeah, you've probably got some access to some really great mountains up in Washington.
Oh, it's great, man. It's wonderful. And we before we were in Washington, we actually came down from Alaska. So we got to ski some places and snowboard some places up there as well. So
that's awesome, man.
That's pretty fun.
What's the like how far is the closest ski lift to you? Is it less than an hour? Man.
Yeah. Well, here or Alaska? Because here,
Washington.
Yeah, we are like in the perfect location for a mix of like going to the city and like watching football games or baseball, or like going to the mountains. We're basically right at the like point before you go into the valley to like get up into the mountains. So like we're probably a 45-minute drive away from the nearest lift, and we're probably a 45-minute drive away, near the nearest lift. They have a lot of snow parks, so we do cross country skiing as well, so skate skiing. So we're within probably a 3-hour driving radius, we've got probably four mountains that we could go to, something like that. That's awesome, man. It's pretty sweet. And then we recently just started getting the Indy Pass, which is like basically independent resorts. It's a couple $100, and you get like 2 full day or all day full mountain lift tickets at every independent resort that participates. So this last winter we were hitting up Washington, Canada. Did we get down to Oregon? I think no, I don't think we got down to Oregon yet, but I think we went like 12 times or something like that. So
wow, man,
it's pretty fun.
Awesome. Yeah, that's really cool. I'm lucky if I can go 2 or 3 times a season. That's usually about my average. I'd love to go more, but there's actually
needed here. I was gonna say it's needed here for us just because the winters are pretty rainy and kind of crappy a lot. Mm-hmm. So if we're not getting out, it wears on you pretty quick.
No, I bet. Go goth pretty quick.
Yeah. Oh man. So I know we've kind of talked about like what type of investor you would call yourself, but on the dividend specific side of investing, like do you lean more towards growth or more towards like, I guess, kind of balanced yield / growth?
Yeah, I would definitely say a balance. I've got quite a mix of everything in my portfolio. I have some high yielders. I have some more high growth dividend stocks that, increase their dividends pretty aggressively on an annual basis, which is really nice. And then I have some more of the steady stalwart companies, the Sleep Well at Night, Procter & Gamble's, Coca-Cola's, those. So I've got a decent mix of everything. But with that in mind, moving forward, I'm trying to put more emphasis on the growth. I don't feel that I need any more high yielders in my portfolio. I don't need any more slow growers. I want ones that are going to have a greater compounding effect, at least in terms of the cash flow. So moving forward, I'm looking for companies that have high dividend growth rates. And to put a specific number on it, if I had to, I'm looking for like a double-digit 5-year dividend growth CAGR if I can swing it. If not quite there, 8% and above, I'm happy with. In fact, that may even be more sustainable long term. But that's kind of my emphasis moving forward.
Nice. Yeah, I mean, I don't specifically focus on dividends. Like, to me, they're just a function of the company, right? So like, I'm kind of more balanced on like, I'll buy tech that doesn't pay a dividend, or I'll buy another company that does pay a dividend. But usually, when I find myself buying what I would consider like a dividend stock, most of them are kind of on that phase where they just kind of started the dividend. It's got like a really low payout ratio, and I really believe like the cash flows over time for the core business are going to increase drastically. So as long as management keeps up kind of passing that through dividends, you should get really, really good growth out of the dividend. So I would say, yeah, I'm probably more on that dividend growth side as well, but I do have a couple high yielders in there. KRC.
Yeah.
But
I just bought some more of that one this week, actually.
Really? Yeah. I added a little bit more, just a little bit more this month. So I'm kind of on the REITs that I've established over the last, I don't know, 2 months or so. I'm built out pretty well to where I'm happy. So I'm just kind of nibbling as I'm getting dividends and kind of just accumulating while I think they're still in a decent value range. So sometimes you just got to control yourself,
I know, man. You got to be careful, especially with a company like that. We don't have to get too deep into it, but it's been kind of a falling knife. It's like it drops a little bit, you buy some more, then it drops a bit more. So you pick up some, even more shares, and then it just kind of is a vicious cycle. But it seems KRC seems like it's sort of bottomed out of around where it's at, near $30 per share, somewhere between 27 and 30 or so. We'll see. Hopefully I didn't just jinx it, but yeah.
Yeah, knock on wood.
Exactly. We'll see what happens.
No, I agree. I think I think the market's been pricing in a lot on negativity for the real estate market in general, especially when it comes to just like asset values of the real estate that they actually hold. So it'll be interesting to see how far ahead the equity market is with pricing in REITs versus I would say the current market that we're in, where we're seeing some of these sales go through. So, I think it'll be interesting. I've wanted to own REITs for a while. I just never kind of saw the attraction on a comparative basis with other sectors in the market. And this was the year, man. This was the year. So we'll see how it goes, though.
Every dog has his day, man.
Yep. Every dog gets beat down enough to where I'm like, that might be interesting. But all right, let's see. So let's go into a little bit of the, I guess, analysis for the companies that you look into. And do you want to just talk about, do you focus more on the like qualitative side or the quantitative side, or is it a mix of both? And you can go into each qualitative and quantitative side as much as you want.
Yeah. So starting with I would say I start primarily with the quantitative. And if I first hear about a company or am interested in learning more about a company, the first thing I'll do is I'll go to Seeking Alpha, which is my stock research platform of choice. I know there's plenty of other good ones. A lot of people don't like Seeking Alpha, but I've really enjoyed using it. So I'll go to the Seeking Alpha, look up the company. First thing I'll typically do is just go check out their financials real quick. Just take a quick scan. I'll look at the income statement. Are they growing the top line? Is their profits growing along with that? Earnings per share, what's that looking like? Or what's the bottom line looking like? Free cash flow, what's happening there? Debt, is it manageable, if there even is any? And so if most of those things kind of check out, or if I can get a gauge of whether or not this company is growing, number one, even whether it's slowly or aggressively, are they growing? Are they seeing growth? That's important to me. Number two, is their debt manageable? Are they able to keep that in check? Is it too out of hand? If it's too out of hand, then it's probably one that I just don't really want to deal with. Free cash flow, is that covering the dividend and then some? Is there still some wiggle room there? Those are just at a very basic level. That's kind of what I'm looking for. Share buybacks too. It's not a complete deal breaker, but like to see a history of that for sure. Depending on the company too, there's exceptions. If that all looks pretty good, I'll take a look at the dividend stats. Is this something that I might be interested in? Especially with kind of my goals moving forward, I'll look and see if the dividend growth CAGR is high. If it's not, and if it's just another high yielder, then I'll likely pass on it, just because I don't need another one of those in my portfolio. So I'll in general see if the dividend stats align with my goal in that arena. Take a quick look at the valuation. I mean, super quick, just the relative valuation metrics: PE ratio, price to cash flow, price to book, if applicable. And that's, I can do that probably in 3 to 5 minutes. And that's kind of my quick screen to look at the quantitative stuff before I decide it's one that I want to look at further. But in that, I also, I need to know what this business is or what it even does. So if it's a company I've never heard before, what do they do? Who are they? How do they make their money? And if I can't wrap my head around that, if it seems like it's over my head, I've just learned it's just not something that I want to probably try figuring out at this point. I've got 20 something stocks in my portfolio right now. I don't know that I want to spend a lot of time learning completely new industries at this point, especially because I'm still learning a lot about how to read financials and how to do those sort of things. So I don't want to put too much on my plate in terms of learning how to be a better investor. I want to make sure I've got one thing down before I get the other. Once I feel a lot more confident looking at financials and some more of those quantitative factors, maybe I can kind of start getting cute and looking into industries and stuff that I'm not as familiar with. And this is a thought that I've just kind of come around to. In the past, I've not really taken that into consideration as much. And I'm learning the more that I do this, how important that is to understand what you actually own, to actually understand the business. And so that's become a huge component of mine. But then, qualitatively, if everything looks good, qualitatively, I'll try and dive a bit deeper and really spend a lot of time thinking about this business's place in the world. How essential are they to their customers? What do the customers even think about the product? Is it one that's the customers can't live without? That's not necessarily a deal breaker, because there's only going to be so many Apples or Coca-Colas or whatever example you want to use. But I'll just try and think hard about more about the quality of the business, I guess. And there's so many different things that can come with that. You look at risks, you can look at risks and see what are the risks facing this company. A good place to do that is like the annual report. I started really trying to spend some time with those, and then thinking about, in addition to these ones listed here by the company, what are some other things that could put them at risk that maybe aren't listed here. You could get into a really deep rabbit hole looking at all the qualitative factors, and it's certainly worth exploring. But without wanting to take up the whole rest of the episode talking about it, that's kind of where I'm starting with my research into a company. Does that all make sense?
It totally makes sense. And I really agree with the qualitative side, where I think you do need to know the industry, like know the customer, the stability of the revenue, the margins, things like that. But the thing that I kind of keep on coming back to is a lot of times the qualitative is reflected in the quantitative. You'll see a lot of, if it's an amazing qualitative company, you're going to see like steady revenue growth. You're going to be seeing steady margins. You're going to be seeing a lot of this, low debt. You're going to see a lot of these quantitative aspects that come from the qualitative. So a lot of times I do something similar where, I'll be looking at the quantitative, because if I look at the quantitative and it's trash, I'm not even going to I'm probably not going to even look further at all, unless somebody that I trust is like, hey, this is new management. It's actually not this company anymore, or something like that. And they're restructuring and they're doing everything just changed. Then I might peek into it a little bit more and see if there's an opportunity there. But a lot of times I find that, the qualitative is reflected in the quantitative, and that can be like a double-edged sword, because sometimes people will take the qualitative side, they'll almost double count it, and they'll be like, oh, well, since it's such a good company, it can trade at a PE of 50 while only having 10% growth or something like that. I'm like, well, to me, not really, because you're kind of accounting for the qualitative already in the underlying fundamentals and the quantitative, and it's easy to like, I guess, justify overpaying for something that is really, really high qualitative, when the quantitative side just isn't, I guess, lining up for, I would say, reasonable long-term targets, if that makes sense.
Yeah, that makes sense. And it's a difference. I think you hit on something really important. The quantitative will tell you a lot about the qualitative, or maybe vice versa. I don't remember exactly how you worded it.
Yeah.
But the two go hand in hand. And the quantitative we can look at as being the what. What is the revenue doing? What is the growth looking like? There's a lot of what questions that can be answered by looking at the financials. But the qualitative is the why. The qualitative is going to tell you why the what is happening. Does that sort of make sense? And so I think a lot of time needs to be spent on the why. And I think and I don't want to be too mystical about it either, but I think a lot of time needs to be spent on asking these why questions. Why is this happening? Or why has this happened? And that's not an easy thing. And that's the stage that I'm at as an investor. Is I'm starting to understand just how important that is. And so when people talk about it taking a long time, you spending a lot of time researching companies, I think that's more so what they mean. You should spend a lot of time thinking about why things are happening and why things could happen a certain way moving forward. And it's not an easy thing. It's not something that you can do as someone who's brand new to investing. But that's kind of the fun of it. It's very challenging, right? But that's kind of the fun of it is being able to sift through all of that and making it just one big puzzle, and then making a decision based on that, and then over an extended period of time, seeing if you're right or if you're wrong about that. Both of which are learning experiences for you as the investor. So.
Yeah, definitely. And I've kind of viewed it too as like, the more you learn and the more you understand, like you kind of have these lenses essentially that you look at through to assess the market and to assess different risk factors and to assess companies. And slowly, like, as you learn more and more and more, those lenses are going to like change a little bit here and there, right? And essentially the goal is to just constantly be refining those lenses and like getting a better view on the market and a better view on the company and the better view of the probabilities of like actually being able to outperform and the risks involved with those. So I think what I see a lot of, it's very easy to look at like the last 20 years of a company. And that is a good judge for like what they've been able to do up until that point. But the market is always going to be forward looking. And what happened over the last 10 or 15 or 20 years, I think you can take that into account, but you really have to do the analysis based off of, okay, what's the next 10 years going to look like? Do I think management and the company are going to be able to keep up that pace that they did over the last 20 years over the next 10, 15 years? So I think like backwards looking data is pretty good to assess maybe like a quick glance of, how they've performed previously and how they've been able to, I don't know, increase their qualitative aspects previously based on the previous financials. But it's always one of those, like, just because it was good previously doesn't mean it's going to be good the next 5 years. And that's probably the hardest part, is being able to take in all that information and look at the company, the sector, their prospects, and correctly assess like the probability of them being able to meet those guidance numbers or those goals. And then if they do, are you going to be able to essentially profit off of that based on the current price? So, yeah,
it's a tough thing, man. That's a really tough conclusion to draw, because on one hand, no one can predict the future. There are so many unforeseen things that can happen that can completely throw a company or the entire market off balance, and anything can happen. And so it becomes impossible to predict the future. And at the same time, like you're saying, past performance, as the quote goes, past performance doesn't guarantee future results. That's not lost on anyone. But at the same time, in trying to predict, it's a really interesting thing, because in trying to predict the future, which is impossible, you have to look at the past, which at the same time isn't the best judge of the future because it doesn't guarantee anything. But with that said, it's all we have. Yeah. It's all you have. So in a sense, even though it doesn't guarantee anything, to get an idea of what's going to happen next, you have to look at what just happened and use your instinct to see if that's going to continue. It's not a perfect strategy, but that's the only one we have.
Yeah. Yeah. All right. So let's see. I think we breezed over this, but do you have any current thoughts on the current state of the market, where we're at right now?
It just seems like it's all over the place. I don't have any serious thoughts. I just, 1 week my portfolio is at all-time highs. The next week I feel like it drops to, deeper than the Marianas Trench. It's all over the place. And so I don't have any serious thoughts on the current state of it. It just, it's a mystery, and it's going to do whatever it's going to do. I'm trying not to put too much emphasis on what's going to happen next, because like I said, I have no idea what's going to happen next. All I can do is focus on the things I can control, which is the companies that I invest in, and hopefully they're good enough to survive whatever does happen.
Yeah, no, for sure. And I think for most people, almost everybody, that's probably the right approach to take, is focus on your companies and improving your process. And, if you're right long-term, then you're going to be right. You might have a lot of short-term fluctuations, but, investing based off of like a short-term macro level, or like that's just really hard to do. Interest rates are always changing, like inflation is always changing. It's like a bunch of noise that makes everything really chaotic in the short term. And then you look out and you're like, oh, that just looks like a smooth, nice graph. So, all right. So getting on the next one, do you have any thoughts on accumulation strategies? Let's see. And also like portfolio asset allocation. If you want to share your portfolio, you can. We don't have to. I think you share it publicly on your channel, right?
Yeah, I make so people. There's not like a direct link to access it in real time, but I'm always making videos showing what's going on. But what do you mean by like accumulation strategy?
So for me personally, I basically run my valuations, right? And then when I run a valuation, I have basically a five scenario set, where I think in the future, I believe that this is essentially the spread of scenarios that could take place for this company. And in each of those scenarios, I basically do an evaluation based on a 5-year target for each scenario. And then I will, like, maybe I say like I'm very, very confident in the base or the bull case, but I want to do bearish cases and things like that. And then based on like my conviction of the company, and say I want to make it like a 5% allocation, I might stagger my buys into different scenarios, right? So I might buy, 10% in the bullish case, 10% of that my target allocation in the bullish case, and then maybe 30% in the base case. And then I might take a 50% buy, right? A much heavier buy in the bearish case if it gets down there. And that's partly because I'm finding that I'm more kind of contrarian investor based off of sentiment and market sector fluctuations and sector momentum. So I'm usually looking for basically, if I think that a company can do X and that I have these 5 different scenarios, and I believe my thesis is going to hold up and it's getting into a bearish scenario buy point or a very bearish scenario buy point, in my view, as long as my thesis remains the same, the equity at that point is just de-risked. So I want to almost like weight my buys heavier at those points, because it's like the best risk reward for the analysis, essentially.
Got it. I can't say I do anything that in depth. When I just started a position in Williams-Sonoma, for example, a few weeks ago, and my, I guess, allocation strategy with it is just to continue dollar cost averaging into it, chipping away at it week by week, because that's really all I can do. I just invest. I don't typically keep a lot of cash on the side in my brokerage account. Mm-hmm. I'm just kind of just deploying it every single week. And so my allocation plan with that is just to dollar cost average into it until I feel that it's a sizable position in my portfolio. Maybe somewhere between company like that, maybe somewhere between 4 to 6% to start out. And then depending on where the price is at, once I get it up to that level, maybe I'll add a little bit more if it's still looking nice, or if it has a nice run up and gets a bit minty, then maybe I won't want to add more to that. So for me, I guess it's more based on just a rough percentage in my portfolio about, eyeball where about do I want this to be. And there's some companies I can tell I want this to be a big portion of my portfolio. Like for me, that's Procter & Gamble, Starbucks, Johnson & Johnson, Lowe's. And then I don't remember what my fifth one is. SCHD is a bigger position of mine too, but that's a different story. So I can kind of eyeball it and know about how large of a position I want it to be. And then I'll just buy until I get to that point. And like I said, if it's still attractively valued to me at that point, maybe I'll consider adding a bit more. Or if there's something else that's kind of tickling my fancy, maybe I'll switch gears and start buying something else for a little while and revisit it. So it's a very loosey-goosey approach to where my money gets deployed. But typically
it makes sense though.
Okay, well, good.
To me, because I'm like, if you're going to follow, just say a dollar cost averaging strategy, right? And you just want to have the repetition of investing in the market every 2 weeks or month or whatever, kind of the way that I would go about it. And it sounds like the way that you're going about it is essentially you're just, as that cash flow comes in, you're looking at like, okay, what assets are on my watch list or my preferred, I want to own these, and what ones are looking like they are of good value now. Mm-hmm. And then as your dollar cost averaging, you're just kind of like shifting that money into the assets that you want to accumulate that are in that you believe are in like good value areas. Yeah,
that's exactly it. And I think the reason I don't think about it with more complexity than that could have to do with the fact that could have to do with the fact that I'm not necessarily trying to beat the market. I think my end goal with all of this is a little bit different. So, my end goal is to at some point live off the passive income that my portfolio pays me. And so, but with that in mind, I guess I'm still trying to get the most bang for my buck, because the more attractively valued you can buy something, the more attractive that cash flow is. It's you have to pay less for it than you otherwise would have to. Does that make sense?
Yeah.
If it's at a good value. So that could be why I don't think about it as in depth, because I just figure, even if I was to, which I'm not saying don't pay attention to valuation, because it is important, especially if you're buying individual stocks. But at the same time, if you were just to pick a company, if you were just to buy Pepsi week in, week out, no matter what the share price does, and your goal is to live off the income, you'll get to that goal someday. You will get there because you'll still be accumulating that cash flow. And then it's just a numbers game at that point. But, there's going to be still some weeks where you could have gotten a better bang for your buck if you would have put it into some other more attractively valued company that still would help you create cash flow. It's just not trading at as much of a premium. So your dollar is going to stretch a little bit further. Does that make sense?
Yeah. No, that makes sense. The other thing I was going to ask you is, when you're looking at more of these like dividend growth assets that you're trying to accumulate, typically like what what's like the starting yield of those? Because I'm finding that a lot of the dividend growth assets that I'm like, okay, I think this is going to be really solid dividend grower going forward, they're usually like under 2% current yield, maybe like 1 to 1.5% yield. I'm just curious, like the ones that you're stumbling across what's the kind of the starting yield on those?
I would say at least the ones in my portfolio, it's usually between 2 and 3. Like, okay. I don't know the exact numbers off the top of my head, but Starbucks has a yield in the 2% range. Lowe's has a yield in the 2% range. AbbVie, which I would consider to be a high growth dividend stock, kind of a triple threat in the dividend department, actually. Their yield is up about 4%, and they still have a really nice CAGR. So it's kind of all across the board, but in general, to your point, yeah, they are usually on the lower end, and it's not uncommon to find companies with high dividend growth CAGRs yielding less than 2%. It's not uncommon.
Yeah. No, I was just curious because like I like that strategy, dividend growth. Like if you're looking at dividends, I really like dividend growth, especially for people that are younger, around our age probably, because really you're looking at like, if you're getting into a solid company that's going to be growing their cash flows and slowly growing that dividend amount, like imagine what your yield on cost is going to be in 20 years, right? Like a lot of people are potentially chasing yields right now that have a lot of risk associated with them. And there are a lot of companies that I think just get overlooked or potentially not paid too much attention to because they might have a smaller yield, but if that yield is backed by cash flows that are going to be growing steadily over the next 20 years, I mean, your yield on cost in 20 years could be insane.
Considerably higher than if you were to just buy a 10, 11% yielding, covered call ETF, which is, if they're even still around 20 years from now, it's still going to have a yield pretty similar to what it is today. Yeah, man, you hit the nail on the head. And there's a couple of things there. I mean, with dividend growth companies, in addition to the substantial yield on cost you can receive from them over time, they're good ones to own because a company that is only a company with sound financials and sound fundamentals is going to be able to responsibly sustain dividend growth over an extended period of time. And those are the kind of companies that you want to have in your portfolio. So it's not the end all be all, but it is a sign of financial strength if you can find a company. There's exceptions for sure. Just because a company's a dividend king doesn't mean it's, you need to buy it. Or it's going to be a good one. We've seen that play out with multiple different companies so far this year. But it can be an indicator of financial strength. It can be. And the other thing too is with the high yielding companies, I certainly understand the allure. Why would I buy something that's 2.5% yielding 2.5% today when I've got this thing over here that I don't have to wait 20 years for that, or 15 years, whatever it is. I can get that today with Jeppy, or I can get 5 times that today with Jeppy. It's a hard thing for people to wrap their head around, but it's so important to have that long-term mindset, because if you don't, you're going to make decisions that might sound good today, but over the long term, when you will still be investing, won't be as beneficial.
Yeah, for sure. Well, and especially when it comes to, I mean, I would just encourage people to have a long-term mindset, as in like, we tend to try to get instant gratification in a lot of places, whether that's looking for a 15% dividend yielder currently versus, buying something that has really solid fundamentals that can grow for a long period of time and kind of return to you increasing dividends that way. But in general, I just see so many things that are kind of flashy and potentially structured in ways to satisfy that short-term instant gratification. And I just like to tell people, there's no free lunch in the market. you know, uh, there are people out there, there are institutions out there with a lot more money than us. And, if something really is that easy, that arbitrage is going to be closed pretty quickly. So just be very cautious and skeptical when it comes to things like that, because, on the surface, something can look very good, but there's typically no free lunch in the market.
There's no free lunch. Anything worth having, anything worthwhile will take time and more effort than you would imagine to get there. That's, investing is not a physically strenuous activity, but it takes a lot of patience. It takes a lot of effort. It takes a lot of discipline. It's not an easy thing to reach financial freedom. It's worth it, but it's certainly not as easy as just buying Jeppy and calling it good.
Yeah, for sure. Well, and like historically, I mean, the reason investing is so hard, even if you are really great at the quantitative and the qualitative, is just the psychological and the emotional aspect.
Absolutely.
And I don't think, that's where most people are going to fail. Is if they get to that point, the psychological and emotional aspect is very, very hard. Mm-hmm. And being able to, behave in a way and manage portfolio way as an investor, long-term investor, that is going to limit your short-term decisions based off of maybe your emotions being toyed with. Now, theses can change, and if a thesis changes and you're like, I got into this stock and my thesis changed, and I thought this was going to happen and this happened, know when to hold them, know when to fold them, right? There's no shame in that. But, there's a lot of times where just overall market movements, going through COVID, we have 15, 16% down days, and people just start freaking out. And it's like, oh my gosh, I just lost 15% of my portfolio in a day. And then I think that crash recovered in 3 months. That's insane. So you just got to be very, very careful. And it's almost like know thyself, know your emotions, and be very aware of what's happening. And it's a hard thing to balance for sure.
It's a hard thing to balance. At the same time, it's also a really important thing for people to go through. You got to be able to take those gut punches where there are those big swings. And I don't know. I think for a lot of investors, a little bit of stoicism will go a long way. I think that taking a step back, zooming out, and like I said, just deploying a little bit of stoicism and just knowing that things are okay, being calm about the whole experience. I think that will really help a lot of investors who do freak out when they see those big drops. So what we would say in the dividend investing community when that happens is, we always try and look at the silver lining, and we think that no matter what the market's doing, there's some sort of positive that can be gained from it for dividend investors. And we say, it just means it's going to be, if you're seeing these big drops and nothing's wrong with the company, it's just going to make it easy to buy that income. It's going to make it easier to increase your cash flow, number one, but also number two, great. I'll be able to buy this company with a higher dividend yield than I could yesterday. So I'm not mad. In fact, I'm buying more. You got to be careful with that. Obviously, just because the stock goes down doesn't mean it's one to buy. It just comes back to knowing the why. Why did it go down? What happened as it went down? Why did it go down? But but kind of changing your perspective a little bit. And also, like you said, adopting the long-term mindset and knowing that even though this happened today, this is not the end of the story. Tomorrow it could go back up double the amount. You just never know what's going to happen. But you also have to have faith. If you have a long-term mindset, you have to have faith that across in the next 5 years or 10 years or 20 years, things are going to look better than they do today. So you hang in there.
Yeah, definitely. Cool, man. Well, lots of talk on money. It's been fun. Now, kind kind of the next question is, we talk about money, and obviously like anybody watching this is probably pretty financially focused, like finance focused. So I thought this would be a fun one to throw in there, and most of us have the goal of, increasing our portfolios or, increasing our net worth. But at the end of the day, what's the end goal for you? Like, I mean, and not necessarily financially as far as like a number, but like, how does that play into like your life goals, in the future?
Yeah, that's a really good question. That's a really good question. My end goal with all of this is to use the income to just pay my bills, fund my lifestyle. Mm-hmm. But taking that a little bit deeper, it's just by being able to do so at that point, this is probably cliche, but at that point you're free. You don't have to, you're not tied to a job. You can, in theory, just do whatever you want to do. And in my mind, that's the most important thing. I've never liked feeling like how do I say this? I guess this is going to sound bad, but I've never liked being told what to do. I know that's not a good thing, that I don't know, but I guess worded a different way, I've always wanted to be in control of my own life. I've always wanted to just do the things that I want to do. And so that's really my motivation with being an investor. That was one of my motivators to start my channel. That's a big motivator for a lot of the things I do, is just doing things because I want to do them. We only have one life to live, and I don't want to spend it doing things that someone else tells me, especially if it's something that I don't even want to be doing in the first place. So, and I think in today's day and age, there's no excuse to not start taking steps. And actually, before I finish that statement, I think this is something that everyone wants. I think everyone wants to be financially free so they can do the same thing, so they can live life on their own terms. I think that's what all of this is all about. And I think everyone should be doing something like this. I don't think there's really a good excuse to not at least start investing. In today's day and age, you can do it anywhere in the world. Okay. You just need to have connection to the internet. You don't need an arm and a leg to start investing. You can start with as little as like $5 a day if you wanted to, or $5 a week. You can start with the pennies that you have in your pocket if that's all you have. Something's better than nothing. And you don't even have to think about it. You can buy things like ETFs or index funds or mutual funds, and it does all the heavy lifting for you. You just have to feed the portfolio and, go on living your life, and check it in 25 years and you'll be in a pretty good spot. So I think this is something that everybody should be doing. In going back to the channel, another reason that I am so gung ho about this stuff is I just don't think there's anything better than being free. And so one of my missions with my channel is to show people that if I can do this stuff, and I'm not there yet, but if I can work towards this, if I can do it, then really anyone can do it, and everyone should be doing it. So I want to show everyone that it's possible. Even you with a couple of pennies in your pocket, you can start doing this as well. So I think it's just a really important thing.
Yeah, that's cool. So. Well, and with the, like, just if you're investing $5 or whatever, it's habit building, right? It's getting to the habit of just trickling money in over and over and over again, and being comfortable with it, and being comfortable with market fluctuations. If you're buying like a VTI or something like that, like a total market fund, and it's just kind of building those long-term habits. And I think you're right. Like, everybody needs to not focus on this a ton, but they need to have an understanding and a plan, at least for like traditional retirement too. Like, a lot of times we talk about like early retirement, or being able to have that flexibility a lot sooner in life, but you're gonna have to at least plan for like 65. Right, and being able to have your nest egg be built up for that retirement. So yeah, man, good stuff. I've kind of always thought of it for me as like being like, at first it was like, oh, I don't want to like work. Like that might sound bad, but no, I don't want to work. Right. But when I dug deeper, it wasn't that I didn't want to work. right? Like there's things that I really love doing and I enjoy doing them. It's that I just want to have more optionality, right? I want to have a little bit more optionality in my life, whether it's, with my job, with my schedule, whatever. And so for me, like a big part of my, I would say first, I don't know, like 23 to 28 or something like that was just so focused on like saving. And eventually I kind of made a switch and I was like, you know what, like, savings is great and investing is great and building that portfolio is great. But like, if you're miserable for 10 years of your life just to get to one point and like your, mindset is maybe a little bit too skewed, right? Because like once you get to that point, like what are you going to do? So I've been focusing, I would say the last 5 years now on probably just finding more balance, right? Being happy with where I am currently and continuing to, I love saving and investing. So continuing to save and invest, but really finding a balance of like, you know what, like I enjoy where I'm at. So I think there's something to be said for, if you're watching this and you're like gung-ho for financial independence and stuff like that, just make sure, I would just encourage you to take a somewhat conscious, balanced approach, because there can be maybe, financial independence sometimes can be like a 15, 20-year journey. And there can be changes that you can make right now that will really increase your happiness during that journey. Because I mean, the end goal is just to probably, at least for me, is to really enjoy what I'm doing at every stage of my life, because we're never going to get this time back. So while I still want to free up my time in the future, make sure you're having an enjoyable time in the present.
Yeah, I'd agree with that for sure. You don't want to, I say all this, but at the same time, I don't think one should live like a hermit and pinch every single penny to just shove it into their portfolio. That's not a really healthy way to go about it. You're right. You need balance. You need to have fun. You need to live life, or else you're gonna go crazy, and the journey to get there won't be as enjoyable. So you definitely have to find the right balance. One interesting thing, one kind of last thing I'll say on this particular topic is one of the other things that, kind of talking a bit about balance a little bit, this somewhat applies. One of the interesting things that you learn inherently from doing this, or at least this is how it worked for me, is once you start putting money into your portfolio, and once you start, just speaking in terms of dividend investing, once you start getting some of those passive paychecks coming in, it's very interesting. It's almost like a switch goes off, and it starts to change your perspective a bit. You start to see, number one, I mean, if I just continue down this path, you start to see more of the light at the end of the tunnel as those paychecks get bigger and bigger. But at the same time, some of the other things that maybe you thought were important to spend money on before no longer seem as essential. You start to realize I'm okay without the pair of jeans that I just tried on, or I'm okay not spending money on this. You start to kind of weigh more of the opportunity cost in your head a little bit about where you're spending your money. And I think overall, just by investing, it makes you a more financially prudent individual. Now, once again, that's not to say you should live like a hermit and only spend money on stocks and building financial freedom, but you'll start to take account of what's really important to spend money on and what's not. You won't be as loosey-goosey with, I think, how you're allocating your budget. And so it does help you more with that balance, because speaking about balance between investing or discretionary spending, a lot of people are heavily weighted, without even knowing it, heavily weighted towards being consumers and spending money on things that they likely don't need. I think we could all agree on that. And so by investing and kind of going the other way, it pulls you back to center.
Yeah, no, definitely. And I've been budgeting for 10 years now, a little over 10 years now. And I don't do it as strictly as I used to, but what I found is that, and kind of my current philosophy at my current stage in life is that I really suggest that people like at least track their spending. So at the end of every month, they can be like, oh, I spent XYZ on food. I spent XYZ on like clothes. I spent, just those amounts, because sometimes you don't realize your spending habits and how much you're spending at some points. And at a minimum, I really encourage people to just track that. And at the end of the month, review it. And if you're like, oh my gosh, I spent this much on this, like you're almost going to self-regulate and be like, oh, I should probably, like scale that back a bit.
Absolutely.
And vice versa. If there's things that you really enjoy and really bring you like a lot of fulfillment, and you're like, oh, I spent $500 on that thing last month, and you don't really think about it, it was probably worth it. Right? Because if you're saying, I spent $500 on this thing last month or this category last month, but man, that was so worth it because I got to do X, Y, and Z, and I had such a great time. Like it really just is kind of like this quick check to be like, where is my money going to where my real values are?
Mm-hmm. I think we all have that thing too. That one thing that we're okay spending money on. I know for me, it's like eating out at restaurants. I don't go to super fancy restaurants or anything.
Yeah.
Being in Vegas, there's a lot of great places to eat. And
yeah, I bet
that's one of the things that my lady and I like to do. That's one of the ways we like to go out and have fun, is try these different restaurants. And, but outside of that, outside of that, we keep it tight, but we, have fun, put the money away, pay the bills, kind of got a good balance between all that.
For sure, man. For sure. All right, man. Hey, this has been great. If you're watching, go ahead, comment questions down below. If you want to see more of this content, feel free to like and subscribe. And I'm going to be trying to do probably one of these a month, most likely, with different guests. So shoot your comments and your questions below in the comments section, and we will hopefully do a follow-up Q&A with Ryne. So thank you so much, man. This has been a lot of fun, really enjoyable. I really appreciate it, man.
Jesse, thank you. I'm really honored to be the first guest here with you. So
yeah, first, man, the ultimate first. All right, man. Thanks, everyone. We'll see you later. Hey, if you like videos on investing and discussions on investing and asset allocation, portfolio management, and just stock valuation, feel free to like and subscribe to this channel. I would really appreciate it, and we'll see you around.